in a credit society, we have credit card debt, we have car loans, we've got student loans, we've got mortgages we want. We've got all these things that are tied to rates. How important is that story?
Well, in that context, interest rates is the most important input. And as you said, we are...
In the economy right now?
Yes. We are a credit
More than trade?
Yes.
More than tariffs?
The most
more than
important
Trump.
factor, by far the most important thing. We are a credit-dependent, debt-dependent economy, as you mentioned, where the cost of money is the driver, both in terms of consumer spending decisions, but also corporate spending decisions. In the mid-2000s, a lot of the credit bubble was manifested in housing and at the consumer level. This time around, it is at the corporate level, but the consumer also is going to get impacted. And we're already seeing it. Housing and autos are the two most interest rate sensitive consumer spending pieces of the economy, and they're already beginning to soften.
Because there are two sides to the interest rate story. There is the consumer side, as you just noted so well. We've got all these rates, some of them are variable, or if you want to buy a mortgage, it's going to be more expensive. We're going to actually talk more about housing in just a few minutes. But you've also got a few trillion with a T in corporate debt outstanding, which at some point is going to have to be paid off or refinanced.
Right. Corporate debt as a percent of GDP, actually total business debt as a percent of GDP, is at a record high.
And much of that is El Junco.
Yes.
I think the technical term is not good.
Well, in the investment grade category, it's the largest percentage of BBB credits that we've ever seen.
Which is low, by the way.
Which is, the rung right above junk.
Yeah, it's B minus, by the way. See, if you're not familiar with the rating scales, BBB minus is the lowest grade you can get before you are junk.
Right, and in with the junk category, there's a high percentage of CCCs. We also have a large category of leveraged loans, which benefits from a lender standpoint with rising rates, but is a threat to junkier credits.
Why is the stock market seemingly ignoring all this?
I think the stock market right now is seeing what's right in front of them, and that's an economy that's still growing 3% and earnings that will probably be good for another quarter in the next couple of weeks.
The stock market's the driver who looks just in front of the car.
Exactly.
Not down the road at the deer who's slowly walking out behind the tree, but straight ahead.
I think the stock market is a much less effective discounting mechanism and is really just much more reactive nowadays.
Okay, but I'll challenge that a bit and suggest that maybe the rest of the world's issues, not problems, because things are pretty good most places, but the Italian thing that's coming out, trade talk that we just hit on,
right,
maybe that still just makes us a little bit more attractive.
Well, that's been the case all year. But the accidents that we've seen this far this year, the blow up in the VIX trade, Turkey, Argentina, Italy. Now, to me, Italy is the canary, particularly in the European bond market. To see Italian yields back to where they were many years ago before the ECB instituted negative interest rates and all this QE tells you that this is the beginning of the effect of central banks pulling back from their extreme accommodation.
Listen, the market commentary last night was that the move in bonds, especially late day yesterday, was a bit unexpected. I mean, rates have been backing up. They've been getting more expensive for a while. If we could bring up maybe a 1 or 5 year chart of rates, going up is no surprise. I think reading some trader commentary and talking to some people last night, the velocity of the move in bonds caught a lot of people flat-footed.
No question. On January 1st, you got 2.4% in a U.S. 10-year. Today, you can get that in a 6-month T-bill.
Yeah. Yeah, and all the things that are tied. Mortgage rates, again, we're going to talk more about housing in just a few minutes. They're not directly tied to the 10-year. It's not like that goes up this much and therefore rates go up this much. There's all these other different factors.
Right.
But it's just taken maybe a couple $100 a month out of the consumer. Right. Because we've got to pay. Gasoline prices, by the way, are going up. So any variable rate debt we've got, that just means that maybe the effects of the tax cut might be muted.
Absolutely. Because of just small changes in interest rates on a large pile of debt ends up equaling a lot of money.
Well,